Thanks so much for joining. I'm Camilla Jeffs, CEO and founder of Steady Stream Investments. Super excited to have you guys here. And today, this is our investor education series, and we're going to talk about how to determine your returns when investing passively. So again, this is just a short 20-minute educational session. We'll follow with a 10-minute Q&A. So feel free to drop questions in the chat box, and we will address them at the end. So first off, yep, there we go. So Steady Stream Investments, just a quick overview of the company, right? We help you build wealth by investing passively in group investments. So we offer group investing and also give you a whole bunch of education so you can feel very confident and comfortable in your investing strategies. So the goal here is to give you financial peace of mind, right? I think I struggled for a long time trying to feel like that we were okay financially. And once we hit that, once we started investing and really, making our money work for us, that's when we hit that peace of mind. And then you can really leave a legacy for your family. Okay. So today we're going to talk about three things. We're going to talk about projected hold times. We're going to talk about cash on cash returns, and we're going to talk about profits at sale and what it all means as to you as a passive investor. So first, let's talk about the hold time, right? And so, a lot of questions, I always get this question, like, what kind of return should I expect? Well, of course, we want to understand, we want to know what the returns are in a syndication and just how hard can this money really work for you. And then, passive real estate investing, how does that compare to other investment vehicles? And so that's what probably people really want to know, because I think most people have a general understanding of the stock market, right? And they generally think, well, in the stock market I could make 10 to 12%. Keep in mind though that 10 to 12% number is an average number that's averaged over the last 40 years. So one of the scary things about that is because it's such a really long average, is that means like 20 years ago, it could have been like 20%. And 2 years ago, it's 2%. So that's the thing about, you have to keep in mind about the stock market, because it fluctuates so much. Yes, it's a good investment for the long term, but it's a really long-term good investment. So we're going to talk about why real estate might be a better avenue, because it's not as long in determining a projected return. So, but I do want to tell you, there's never a concrete way to know exactly what your returns will be. Every investment that we go through, that we do, we have a projection. And that's why we call it projected, because we don't know for sure how that property will perform. We have a good idea based on our past history and the performance of other projects that we've done, but we can never know for sure, right? Which is why no returns are guaranteed. You should never, if anybody says it's a guaranteed return, you should be highly suspicious of that. So they're just based on our best guesses, right? And there's always risk with any investment. We talked about that last time. So if you missed that video, make sure you go find that on my YouTube channel, the 3 biggest risks to investing passively. Okay, so first thing, projected hold time. So this is kind of an easy concept to understand, but basically it's the number of years we expect to hold the property before selling it for, right? And so for you as a passive investor, what that means is that that's the amount of time that your money would be invested in the deal, right? Now, this is one of the cons of real estate as compared to the stock market, is that real estate is an illiquid investment, meaning that once you put your money into a real estate investment, you can't just get it out anytime that you want to. Whereas stock market, you can do that, right? Which is why I advocate having some money in both, right? Investing money in both places, having money that you can get liquid and money that is illiquid that's working harder for you. And so just realize that whenever we say projected hold time, that's the amount of time you should expect your money to be out working hard for you. So typically in a multifamily syndication, a hold time around 5 years. Now, this is really beneficial for a couple of reasons. So why 5 years? Why not 10 years? Why not 2 years? Well, let's talk about that. So first off, a lot can change in 5 years, right? I mean, you could get a college degree. You could move, or in our case, you could move 4 times to 4 different states, right? Yeah, don't be crazy like us. You could get married. In fact, you could have 5 children in 5 years. Like it's definitely possible. But, again, crazy, but possible. But 5 years, like it's is a good chunk of time, right? And it's enough time to really earn some good returns, but not so much that like your kids graduate before you even can use that money, right? Okay, number 2. So if we talk about market cycles, if you've ever studied anything in the market, you know that real estate is cyclical, right? So which means some years it goes up, some years it goes down, and it kind of depends on the years. Now, a lot of people probably remember 08, 09 when it went down hard, like really bad. That was rare. That was a rare event, but real estate is cyclical in that even though it went down hard in 08, 09, it has fully recovered and gone beyond what we saw in 08, 09. So that's really, it's good to keep in mind. So 5 years, really modest amount of time to invest, gives us time to make improvements on the property. So if we are buying a 100-unit apartment complex and we need to renovate all 100 units, we probably need about 2 or 3 years to get all of that done, because we don't want to do it all at once, because then we have no revenue and then nobody makes any money, and that would be sad for all of us. It also allows some natural appreciation. So we've talked about before how we have forced appreciation, where we go in and we raise the revenue or we decrease the expenses, and that makes the property worth more. But then there's also natural appreciation, and we all know that real estate naturally appreciates over time. And then we can exit before we have to remodel again, right? So about every 5 years, properties are being remodeled because fashions are out, things go out of style, the gray paint is out. I think beige is coming back in, right? There's all these different things, and you have to make sure that your property appeals to your tenants and what they want. Okay, third thing, 5-year projected hold, it kind of gives you a buffer, right, between the sale and the loan. So typically loans are 7 to 10-year loans, commercial loans. Commercial loans, they don't do 30-year mortgages like we do on our homes, but they give out like 7 to 10-year loans. So if we hold the property for 5 years, but say at year 5, it's not a good time to sell, right? The real estate market went down for some reason and we want to wait. Well, we have a buffer there. We have a couple of year buffer where we can hold it for longer if we need to. Okay, so now let's talk about cash on cash returns. And then back to the 5-year hold, that's important too, to be able to calculate your average annual return too. So that when, there's a start date and an end date. When I was investing in single family, I didn't have an end date. So I couldn't ever calculate what's my average annual return, based on how much I sell it for and all the cash I receive. Like it was just too hard to calculate. But in large multifamily, it's nice because we have a clear end date that we're shooting for, and therefore we can project what the returns will be. So now let's talk about a return called cash on cash. Now, this is also like cash flow. A really easy way to think about it is, okay, if I'm going to put $100,000 into this project. Well, how much money am I going to get on a monthly or quarterly basis, right? How much cash is going to be flowing into my account because I invested in this property? So in most of these properties, we try to aim for 8% per year, right? So that means you invest 100,000, you earn that 8% per year, then you'll get about $8,000 a year, which is about $667 a month, right? So over 5 years, that's $40,000. So returns of 8% per year, cash on cash, right? Now, just for fun, if you invested that in like a high interest savings account that earns 1% over 5 years, you'd get $5,000, right? As a difference of $35,000 over 5 years. So definitely a much better investment than your high interest savings accounts, right? So that's the projection. Now, one thing I want you to keep in mind is that sometimes if you're invested in a project that's called value add, a value add project means that's one that we need to go in and we need to do some renovations to it in order to increase the revenue. So sometimes it's not an 8% per year every single year. Sometimes, it's an average, right? So sometimes it's 4% the first year, and then it's 8% the second year, then 10%, then 12%, and then all averaged out. I don't know I didn't check the numbers for sure, but it would be about 8% per year, right? And so that's what you want to look forward to for cash on cash. So 8% per year is a good cash on cash return. And even if you were just earning that 8% per year, that's still in 5 years' time often beats the stock market. But there's more with real estate. This is the power of real estate that I really love, is that not only you're going to get that cash flow, but you also get a pretty big check at the sale. So the largest puzzle piece, right, is how much could we sell it for in 5 years? And we determine that based on some pretty intense calculations, right? So we do this whole thing called underwriting, that is a financial analysis of the property. And we try to figure out how much could we sell the property for in 5 years, and how much will everybody earn on that. And so typically we aim for about 60% in profit at the sale in year 5, right? So if in 5 years' time, right, remember units are updated, we got really great tenants in there, and the rent is at market rent. And then because commercial property values are really based on the amount of income generated, then the improvements, they lead to a pretty substantial increase in the overall value of the asset. And that's why we can have a 60% profit on sale. So what does that look like overall? Well, typically the deals that we do, we look for the following. We look for a 5-year hold. Just remember, we like to have enough time for it to appreciate, for us to execute the business plan, and to go in and renovate the units or make any improvements that we want to make. And then we have 5 years to really generate some good cash flow for everybody. We like to look for 8% annual cash on cash returns. So we want to make sure that we're getting some good cash flow for everyone. And then 60% profit on sale. Okay, so what does that mean to you in real dollars? Well, if you invested $100,000 and we hold it for 5 years, right? You're getting that $8,000 a year in cash flow paid out, monthly or sometimes quarterly, depends on the deal. And that equals $40,000 over 5 years where you get that cash flow. And then you're going to earn another $60,000 in profit at the sale. So that results in $200,000 at the end of 5 years. So remember, that's your $100,000 you put in, and then $100,000 in returns. So that's doubling your money in 5 years. That there's no way you're going to find a savings account like that, right? So that's the power of real estate here, is these are the types of returns that you could definitely achieve in investing and doing passive investing in real estate. And the other cool thing about passive investing is you don't have to do the hard work. You don't have to be the landlord in order to achieve these types of returns. Ask me how I know, right? Like, being a landlord was, it was great for a lot of things, but it was not great for other things. And so it's so nice to be able to invest passively and achieve some pretty awesome returns. All right. So if you want to learn more, then feel free to sign up for the SteadyStream newsletter at my website, steadystreaminvestments.com. I do have a free masterclass called Passive Investing Made Easy that goes over all the basics from A to Z, and it's the perfect place to start. And then I have several guides on my website at CamillaJeffs.com for real estate investing. So with that, let's go to questions. Another question here. It says, what do you typically see after the 8% preferred returns? Is it 70-30 splits up to a certain percentage or totally different by syndicator? Great question, Matt. Thank you for asking that. So after the 8% preferred return, so the splits there, they can vary. They do vary by syndicator and by deal. And it just kind of all depends how the numbers work out. But a 70-30 is a very typical split. Sometimes I see 80-20, sometimes I see 60-40. Very rarely do we see anything outside of that 80-20 to 60-40 range. And that's what the splits will be. But here's the nice thing about the splits is that we're still trying to achieve that goal of doubling investor money in 5 years. So whether the split is 70-30, 80-20, or 60-40, it's still adding up. All the numbers add up to that end goal of trying to double investor money in 5 years, right? So trying to get you between an 18 to 20% return over those 5 years. All right. Anyone else have a question? Oh, someone said, speaking of underwriting, don't you have a course coming up? And I do actually. I will be teaching a course on underwriting, and I'll definitely send out more details on that. It's an underwriting club, is what it is, and it's an 8-week course where we spend the 4 weeks really diving deep into the tool that we use to underwrite, and then we also spend the last 4 weeks underwriting deals live, and you can bring your own deal, and we'll underwrite it live and work on that too. Okay. All right. Great question from Lorena. Do people usually take the monthly income as income and do a 1031 exchange at sale? Great question. So with the income, and this is going to go into tax strategies. So we can talk tax strategies, and I'm planning to do another course on that too. But I'll give you a little preview, right? So tax strategies for real estate for passive investing. When you invest passively into a real estate investment, the really cool thing about this is that even though you don't have to do all the work and you're not the landlord, you are still a direct owner in the real estate property, which means you get all of the tax benefits as if you were the landlord or the one running everything. And so depending on your investment percentage, you will get those tax benefits. So what are the tax benefits? Well, one really big one is depreciation. And in single family investing, you get depreciation based on a straight line, meaning that they say, okay, you bought the property for 400,000. We're going to divide that by 28 years. And then every year you can take that figure off of your taxes, right? You can call that a loss on your taxes. Well, multifamily, we have this cool thing that we do called a cost segregation study, where we can go in and we say, well, actually, carpet doesn't last 28 years and fixtures don't last 28 years. And then we pick apart all the little things about a multifamily apartment complex, and we depreciate them based on, carpet lasts 5 years and fixtures last maybe 7 years. And then we can depreciate them on an accelerated schedule. Okay, so what does all that have to do with you as a passive investor? Well, for you as a passive investor, that means that you will get a really big, if we call it bonus depreciation, tax loss in year 1 of the investment, right? Well, okay, you invest in it, and then the next year you'll get the K1 that's showing a very large loss. So in theory, what happens in theory is that loss really offsets the cash flow that you get for the first 5 years. Now, hashtag, I'm not a CPA, so everybody needs to check with their own CPA for their own specific situation. But for the majority of people, this is what happens for them. And then at the end, when you have the sale, right, it is a capital gains event. So keep that in mind, that you will be asked to pay capital gains on that. However, check with your CPA, because they have all sorts of strategies to protect that money and things that you can do. And speaking of one of those strategies, right, Lorena said a 1031 is one of those strategies. So definitely you can look into doing a 1031. One thing I would caution you about 1031s in passive investing, though, is that not all syndicators will allow a 1031 into a new deal. So you'll have to work with syndicators to find out who will allow that, if that's a strategy that you want to deploy. Okay. I have another question. Can I invest in a deal through my business savings instead of my personal savings? And what are the pros and cons of doing so? So, great question, Divine. No, not a stupid question. um, this you definitely can, right? I have a lot of passive investors who will invest via their business, via an LLC. Some will even open up an LLC just to invest passively in these deals. Now, what are the pros and cons of doing that? Well, one of the pros is just an extra layer of protection because remember, an LLC is a limited liability company. So if anything ever happens, the only thing that people can get access to is through that LLC. So just an extra layer of protection if you feel the need to have that. What are the cons? Well, the cons, you have to open up a business banking account and you have to manage another account and make sure the funds go in and out of that account. But really, there's not a lot of cons. Well, and then filing your taxes because that entity will need to file taxes. So those are some of the pros and cons to doing so, but you can definitely do that. And probably about half of my investors will invest via a business account. All right. Looks like that's all the questions. All right. Well, thanks so much, everybody. We will do this again in January. So again, I hold webinars like this twice a month. And so we'll resume back in January. I'm going to be off for the holidays and I hope you guys have a beautiful holiday season with all of your family and enjoy everything that you're doing. So thanks everyone. Really appreciate you being here. And for those of you watching on YouTube, make sure you subscribe. Please share with others so that they can hear this information as well. Thanks everyone.